Welcome to the a16z podcast. This is Margaret Wenmakers, and I'm here to introduce a conversation that took place last week between Fortune reporter Dan Primack and Marc Andreessen. Last week, we hosted our annual LP event where we gave an overview of where markets are headed and what the issues and opportunities are. So here's a recap between Dan and Marc. I hope you enjoy the conversation.
So let's talk about stuff. So let's talk about a bunch of stuff. Let's talk about some of the stuff Scott talked about, and then some more Andreessen Horowitz specific things. And the big trend one of the big trends he talks about is the private financings replacing the quasi IPOs. Companies staying private longer, et cetera. We've also seen he didn't talk M&A much, but there's been relatively little big tech M&A. I think the last so-called unicorn ones were probably Nest and Oculus and Mojang, if you want to count that. But that's all over a year ago. Yep. How are you, if this is all true and this is going to persist, how are you guys going to get paid on your big companies?
Yeah, so this is, I think, this general question, I'll come back to this specific question, but the general question is probably the single biggest thing happening in the business world right now. And it's actually really fascinating because there's a group of people who have really wrapped their heads around what's happening in the public market, around activists and value investors and buybacks and dividends and all that stuff. And then there's a group of people who have really wrapped their heads around what's happening in the private market. And there's very few people who actually, in my view, kind of connect the dots between the two. And I think you can't look, as Scott, I think, made a compelling case. You can't really look at one independent of the other. So my favorite statistic is that buybacks and dividends in the S&P 500 this year will top $1 trillion, right, for the first time, right, which is like 20x the total amount of private tech funding. And so you have a way that's unprecedented. Certainly in my career, you have this sort of structural change happen where the time frame for how public companies think and how they're able to invest has shortened dramatically, like way beyond anything I've ever seen before. And then correspondingly, the time frame for how private companies can think has elongated out further than I've ever seen it before. And of course, the irony or kicker to the entire thing is it's the same investors, right, driving that. It's the Fidelity and T. Rowe Price and the hedge funds, crossing over and investing on the private side. They're literally taking money out of the public market, putting in the private market. They tell the public CEO, give us the money back this quarter, and they tell the private CEO, no problem, go for 10 years. And so that, if there's a grand unified theory, kind of for how the market's functioning, I think that's it. It leads directly to the question that you just raised, which is, okay, smart guy, where's the liquidity? I think the answer to that comes in two parts, which is one is, what do you believe about the substance that's being created on the private side? Because if you believe that the companies that are getting built on the private side are the substantive companies of the future, are the companies that are being allowed to invest in R&D, are the companies that are going to ultimately win these markets, up against what have become very soft public market incumbents, then the intrinsic value of these private portfolios is very real and is going to be very large. If, on the other hand, you believe that these are flash-in-the-pan companies that have a single product cycle and they come and go and there's an optimal time for them to go public, and if they don't get public in time or if they don't sell in time, they fall on the other side of the curve, then there's this liquidity issue. But I go through it in that sequence because our belief...
But they do, don't they? I mean, if there's I'll make this up, if there's a 10, 15, 20% pullback in public markets, we saw this, and granted it was just a blip with the SaaS market, I guess, in the spring of last year, spring of 2014. The overall equity value, whether it be Apple or Facebook or Uber, things do cut if there's a macro pullback, right?
Yeah, but they can, and the marks can come down, and there might even be down rounds. But if you believe the intrinsic value of what's happening on the private side will keep growing, then these companies will just work through it. Like if these private companies really are the big new tech companies of the future, then the value creation is going to be so large that's going to swamp the effects. And I would just say, what really encourages us. I'll come back to the cautionary note, but what really encourages us is we think that these private companies are going to inherit the future precisely because this is all happening at the same time that the public companies are being forced to disarm. Right? If it wasn't for this activist movement and if it wasn't for these public companies that are being forced to give all the money back and not being allowed to make new investments, I'd be more worried about this. But if they're not going to make the investments, if they're not going to do the M&A to be able to refresh their product families, if they're not going to make the new capital investments, if they're not going to make the new R&D investments, and if there's going to be talent flight from the big incumbents to the private side, which is what we see every day, then the intrinsic value getting built on the private side is very strong. Now, the trade-off with that is just time. It's the 11 years to IPO. It's the much longer time frame to realization.
Why do you think there's been so little big-scale M&A? The big public tech companies, these incumbents you're talking about that want to grow even though they're doing buybacks, et cetera, have tons of cash. Their stock prices are extremely high. We've got this bucket of 54 U.S. unicorns, 100 global. Why are they not getting taken out? Any of them?
Yeah. So the founder-controlled companies are able to do this. And so Google can do the acquisitions, Facebook can do the acquisitions. Amazon actually can, although it's striking how few Amazon does. Apple could do more. It's striking how few Apple does, right? The biggest deal Apple's done in years is Beats, which is kind of a fine company in many respects, but it's not what you would consider to be kind of a Silicon Valley innovation kind of machine. And then you get this you see this flirtation, Microsoft flirting with Salesforce, and you see these deals, and the deals never actually happen. And then if the deals do happen, it's like Intel Altera. It's like very old school, old world, low PE, combining with low PE. So I think the surface level answer is activists, which is if you're not a founder-controlled company, the pressure on you from the activist community is very, very intense, way beyond, like I said, anything I've ever seen. But it's not just the activists. It's what Scott referenced as it's the activists teamed with the value investors, right? And this is what I've learned. I've now been on the receiving side of the activist thing a couple times now, in my public board work. And the really striking thing that the CEOs all learn the first time they go through an activist engagement is you get the inbound from the activist, and you're like, oh yeah, no problem. Like it's just an activist. It's a crazy guy. Like my shareholders have been with me for 5 years. They like me. They understand me. And then you do the call down to your top 30 institutional shareholders, and what you find out is they say, well, we think you're a wonderful CEO, but we really think this guy has a point. And then before you know it, you're really you start running the math on what a proxy fight would look like, and you kind of realize that you'll lose. And so, as a consequence, basically the entire public stock market. So my favorite little thing on this, Larry Fink, who runs BlackRock, who's a legend in the investing business, has been very vocal about he's literally sent letters to the Fortune 500 CEOs saying, you guys are being irresponsible for giving in to these activists. You should be making much longer term investments, and then you could really be contributing a lot more to American economic growth. And oh, by the way, BlackRock is an activist. If you don't behave yourself, we're going to kick you out. And so that's a sign of the times. And that's what these public companies and the public boards are just, they deal with that every day. And I can just tell you, the board meetings are that. Like, if there's an entry on the board meeting for R&D, like it's at the end of the day when everybody's exhausted, like it's a complete change of how these companies operate.
Let me cite one of, I believe, at least from reading the New Yorker, your favorite venture thinkers, the guy Bill Gurley. His point of view on this is, if a company's got revenue, if it can go out public, if the markets will take it, go. He refers to it as kind of the varsity basketball player. You don't sit, or the 4-year. Once you can get into the NBA, go to the NBA if you can get in. Yeah. Why is that, from your perspective, is that wrong? And do you caution or do you advise your companies against that? Because again, the 11 years is long. That unicorn group, almost all of them could price an IPO today if they tried to.
I think that's right. So I think Bill has a real point, which is there is a real role for IPOs. And the reason why there's a real continuing role for IPOs is because at some point as a company you become an institution, and at some point you need institutional liquidity. Like at some point there needs to be some exit path for investors, and by the way, an exit path for early employees. And then there's all the other aspects of going public in terms of credibility and M&A currency and all the other things that you want. So, many of these, the companies that are going to be the big, enduring, long-term, companies of the future, a very large percentage of them will ultimately go public. Where I would quibble with Bill is Bill focuses a lot on, you can go public. I focus a lot on, okay, what happens a quarter later, and then over the next 10 years, what happens once you are public? And so what we spend a lot more time focused with our companies on is how do you get so strong as a company that if you stay private, you're still building huge intrinsic value. But if you do choose to go public, how do you go public in a way where you can continue to be a strong and vital force? You can continue to invest in R&D, you can continue to do acquisitions, you can defend yourself from all the various attacks, you're not subject to an activist deciding to just take the keys away from you. And you can build yourself into a large permanent force in the market. And that's what we're working, by the way, more and more you'll see us work with our companies on that. Like there is a role for this. And I would say Facebook has been a success case of this, right?
Actually, I was going to ask, when Facebook went public, Mark obviously had held, didn't want to, at least the talk was he didn't want to go public, knew he was going to have to eventually, but he didn't do it after 4 years like he could have.
Right.
There was a sense, and maybe this was a media sense, that once that happened, and despite the first day of it, once Facebook proved that it was a successful public company, he could be a public company CEO, they didn't collapse, people didn't all run away, that was going to open the floodgates of these other folks who would kind of look to him and say, being a public company IPO is cool again. I think some people referred to it that way. That didn't happen in the end. It happened for maybe a couple companies, but it's not cool again. This generation of Zuckerbergs isn't doing it.
Well, I think the conclusion that people drew was, if you're Facebook, you can go public. And so the challenge, when Facebook went public, it's over $1 billion of revenue and it was growing very fast. And actually, there wasn't a lesson. There was a lesson that a lot of people carried away from that, which is, and this is something we talk to our companies about, which is when you go public, you need to have the next 6 to 8 quarters in the bag, right? What you don't want to do is go public and then show up with disappointing numbers. And there have been some recent IPOs that have done that, and that's just a really bad idea. So So the thing that I worked with Mark on, and the thing that I think Facebook did, I think quite well, and I think other companies are going to aspire to do well based on that model, is I call it sort of the fortress theory of being a public company, which is you can't go public and be exposed, right? You can't go public and miss a quarter. You can't go public and need to raise cash again. You can't go public, if you've got, a new competitor breathing down your neck, or if your key engineers are about to quit, or you've got some huge litigation exposure on key patents or something like that. You have to get yourself into a position where once you're public, you can withstand all the attacks that come on you, and they bounce off you like Teflon. And you basically have to build yourself a fortress, and you have to do it brick by brick, right? You have to do it in accounting, you have to do it with Sarbanes-Oxley, you have to do it with controls, you have to do it with legal, you have to do it with HR, and you have to take all these elements of building a company for the long term, and you have to take them incredibly seriously. By the way, the preparation for going public is a very valuable thing, right? Regardless of whether you actually go public, the preparation of building your company into a fortress that can withstand all those attacks is also a very good way to build a high-quality company as a private company. And so we are spending more of our time with our companies on that. But this is where I would go back and agree with Bill, is once you get in a position when you're a fortress, if you then choose to go public and you do go public, you will then be able to do so successfully.
I'm curious, do you have companies in your portfolio that if it was up to you, if you were the CEO, et cetera, that would be filing an S1 tomorrow, or at least would be having the process that aren't?
I think I would not second guess them, and I guess I would just say the following, which is we have a significant number of companies in our portfolio that could go public should they choose to in the next 2 years, and that what we are advising them to do is to basically build the fortress, build the company in a way that it would be able to do that if they want to.
Let me move off this a little bit, which is everybody's got these giant briefing books, and I assume there's IRRs, et cetera, in there, and I assume most people in this room have similar books for lots and lots of venture capital firms and venture capital funds. If you're, and I assume, am I right in saying you're an LP in other funds? Are you?
I was.
You were,
yeah.
Not now. Okay.
Yeah.
How should LPs be viewing these numbers? I mean this on the top level. I mean, when we talk about valuation, and if not inflation, I mean, should they read these as these are legitimate numbers? Because obviously they're being marked to the most recent rounds. Should they trust those numbers? I guess is the best way to say it.
Well, they're being marked to models now, right? We're
Yeah.
not actually allowed to mark to the most recent rounds.
Right.
So
Okay. Fair. I mean, should you trust? I mean, if you were an LP in Andreessen, would you trust the number? Do you trust the number?
I would trust that we're running the models the way that you are required to run
That's a different question.
No. But I mean, look, we're not in charge of this. We're told how to do this.
Yeah.
So we're told how to do this. We do it the way they tell us to do it.
Right, but if somebody at the store tells me I have to pay $30 for a Coke and I have to, fine, but I don't believe it's worth $30.
Yes, yeah. So I guess what I would say is, it's actually, I would say a couple things. I would say, number one is, and I think we provide this in the book, I think there's the model and then there's actually the marks, and I think at this point in where the market's working, the marks themselves are actually north of the model. And so if anything, the models are sandbagged relative to the marks. So that's one thing. I think I would personally probably agree with what Sequoia says. So when Sequoia sends out LP statements, they always have this big thing in red at the top, but they basically say is we're forced to give you these numbers, but please ignore them. And basically what they say is just consider everything carried at cost until there's a liquidity event. If you do need to look at something, basically look at the marks, because that actually is the market speaking. The core philosophy that I have that I would go back to is what I said before, which is and I don't know I don't. Derive the numbers on it however you want, but there is this underlying concept of intrinsic value. There is this idea, I believe, that these companies are building real underlying value. I do believe that there will be ways to harvest that value, either in the forms of IPOs or M&A or in private restructurings or other things in the future. I think the big bet is, are these the companies of the future? If these are the companies of the future, they're going to end up being very valuable. Now, that said, we've been very clear with our LPs from day one, with all you guys from day one, is we are shooting to optimize cash-on-cash returns over time, not IRR. And so we don't make trade-offs to goose IRR in any given year. We're always shooting for the maximum long-term value appreciation. All these folks will tell you. We tell them, do not plan for us to be part of your liquidity profile. Plan for us to be, ideally over a decade-long period. Hopefully one of the highest overall cash-on-cash returners. And that's what we focus on the most.
I'm curious. You guys talked up there how you as a firm would buy the kind of the bucket of unicorns over, say, buying Amazon or something like that. I'm curious. Would you right now buy a venture capital index?
Well, I don't believe in the concept.
Well, no, but
I don't believe in the concept of a venture capital index. Okay. Yeah. I mean, I think all of venture. I think you know this. I think these guys all know this well. Venture capital always has been a feast or famine business. And it always has been characterized by extreme power law curves. And I think there's no reason to expect that changes anytime soon.
Okay, fair enough. Let's talk about Andreessen Horowitz a bit. There's this phrase that's always gotten used ever since I've started covering VC, which is that venture capital doesn't scale, and venture capital firms don't scale. It's not a model that does so. So I'm curious, from your perspective, is that wrong? Particularly this idea that the bigger the fund, if not necessarily the lower the return, but the closer to the mean the return is going to be. You can't have the best performing fund and the biggest fund. You guys don't have the biggest fund, but you're up there. You guys you're up there in that top stratosphere. So is that wrong? And why is that wrong? Because I assume you think it is.
Well, so the big driver of returns is, are you in the right companies, right? I mean, it's like if you're in Facebook, if you're in Google, like if you're in these companies, then you have the best returning venture capital fund of all time, and it kind of doesn't matter how big So I think there's a fair amount of voodoo associated with this. We can come back to that.
But if you're a $200 million fund in Facebook and a $1 billion fund in Facebook,
well, it depends. But if you got if you got 1,000x return, like I mean, at some point you're like one of the top returning venture funds of all time, and so like one of the arguments you could make is if you're a larger fund and if you're able to participate at more stages, then you have a bigger chance at being able to be in the really big winners, and that will actually help returns, which is actually what we believe. But there's an underlying thing beyond this, which is the assumption in these kinds of analyses that people do always has an embedded assumption of all other things being equal, and I think as Scott showed in a very compelling way, all other things are not equal, which is the markets really have changed. And so I guess what I would say is if we were in 1985 or 1995 and we were doing this and we came out to you guys with a fund of this size with companies going public on $50 million of revenue, like I don't know that we would be doing what we're doing, and I don't know that LPs would have funded us to do that. But the fact that these companies do stay private for so much longer and the value accretion is moving to the private side, I mean, to us, you adapt. You adapt to circumstances. And so I view that we have adapted to the circumstances that have arisen in the market.
Your reputation, or the firm's reputation, sorry, when I say you, the firm's reputation in not necessarily the early days, but say the middle days of whatever you call it, middle days of a 6-year fund, was that you guys were overpaying, if not overpaying for deals, you were topping out, you were pricing other people out. You were winning deals in part based on that you were willing to pay more than anybody else. And then you personally talked after that, said, well, we're not really doing that anymore. You made a big point of we're not doing that anymore. We have much more price, if not price discipline, we're not paying as much. But that was a couple of years ago. And given what we've seen in terms of where valuations have gone, were you wrong? Should you have kept doing that?
Oh, that's an interesting question. So, first of all, I never agreed with the accusation, and we spent quite a bit of time with our LPs on this. I never agreed with the accusation. I think it was more sour grapes than anything else. People were shocked and alarmed when we started winning deals, and so of course they had to have an explanation for it internally, and that was the easy one to have. We always were ambivalent about whether or not we should allow that misperception to exist, because it turns out it's actually very helpful for attracting entrepreneurs. Like they think that's swell. And
it doesn't work the other way when you guys give them the same term sheet as someone else. They go, "Wow, they don't like us."
Well, or when we give them. I mean, many of the deals we do are under we're the underbidder. Like we are not routinely the and we presented at various times to LPs lots of data on this, and we pass on many deals to evaluation. I will say we did make a bet, between roughly 2010 and 2012, we did make a bet that this sort of expansion stage opportunity had arisen, and that there were these kind of growth rounds that were going to be very big. We're going to generate a lot of gains, and that the market, it was right in the middle of this dislocation. That was right in the period in which the value accretion was shifting from the public market to the private market. But a lot of this had to do with Yuri Milner at the time, right? So I had a sort of a little secret advantage on this one, which is I knew Yuri back before he was Yuri. I'll go through the story because I'll literally explain how we came to this conclusion. So Yuri came through Silicon Valley in I think 2008, 2009 for the first time, and he basically said, "I'm in business and I want to invest." And then he became involved. His first big deal was the Facebook deal. And you may recall. So let's go through what was happening in this time frame. So Facebook had printed a investment from Microsoft at $15 billion valuation. The stuff hit the fan, and there was a serious downdraft in valuations. After the financial crisis, Facebook almost raised their next financing private round at $3 billion. Wow. There was a reset of the process. The economy started to recover a little bit. The process was rerun. American investors, top American GPs, were bidding in the, I think it was $5, $7, and $8 billion level for Facebook, and Yuri came in at 10. It's about, this is about 5 years ago now. Yuri came in at 10 billion, and I remember I was on the Facebook side of this, and then I had friends who were bidding on the American side, and I would call them up and I would say, "You guys are missing the boat. Like Yuri's bidding 10. You guys are going to lose this." And they basically just said, "Crazy Russian, right? Dumb money. The world's coming to an end. This is insane." What I had the advantage of at the time, and what Yuri had the advantage of that I got to see was Yuri and his team had done an incredibly sophisticated analysis. What they basically had done is they had been watching the development of consumer internet business models since 2000 outside the U.S. And so they had these spreadsheets, which was literally across 40 countries, and this is like Hungary and Czechoslovakia and Israel and China and all these countries. And then they had all these internet companies and social networking companies, e-commerce companies and everything that had successfully monetized and turned into real businesses over the course of that decade, completely ignored by U.S. investors, right? And what Yuri always said is the U.S. companies are soft. The U.S. companies are soft because they can rely on venture capital. If you go to Hungary, you can't rely on venture capital, so the companies have to make money. So he had a complete matrix of all the business models across all the countries and then all the monetization levels by user and then all adjusted for GDP. And out the bottom of that model came, therefore, Facebook will monetize at X. And his evaluation of what Facebook would monetize for was like 4 times higher than anybody else's evaluation of what Facebook would monetize for. And so he literally got the deal, and he made now 24X on $1 billion of capital in 5 years. And he did that on the basis of superior analysis, right? Which I still to this day greatly enjoy teasing my friends who missed that deal. Which is he had the secret spreadsheet and you didn't. And so, I saw that, and then we saw a similar thing happen at Twitter, and we saw a similar thing happen to these companies, and we basically made a bet, and this was our Fund 2 bet, and we basically said, there are going to be a set of opportunities that are going to be really, really special, where basically people literally do not, a lot of investors just are still scarred by what happened in 2000, and they really don't understand what's about to happen with some of these companies. Now, to your question, the last of the big valuation bets we made from scratch. So the last new investment we made at north of $1 billion in a company we weren't previously involved in was Airbnb. And that was what we viewed, for us, that was the last opportunity. And that was like 3 years ago now. That was the last opportunity to just snake a deal where to us it just seemed obvious that the thing was going to be just a gigantic global business.
So do you think you've missed the boat on a bunch then?
Oh, so if you just literally do it based on marks, there were a whole bunch of other deals we should have done. Our response to what happened with us is when the public market investors came crossing over, we just made kind of a fundamental decision that said if we're going into a company fresh, and if we're competing with Fidelity, one of us is probably making a big mistake because the return profiles are just, the return profiles and the time profiles are just different. And so you guys see this in the portfolio. Our strategic decision was we'll go earlier. And this is a huge advantage to having a multi-stage fund. And so we've been far more aggressive in Fund 3 and Fund 4. Now, we still have made selective bets at the growth stage in companies that we're already in. And so, for the ones that we have the most inside knowledge on, and where we think that there's an appropriate opportunity, with our kind of return, balanced in the right way, then we do that. But we feel really good. Look, put it this way, we feel like we're not missing. I don't regret any growth investments we didn't do because for every growth investment we didn't do, we did 5 or 10 A's or B's. And if this market continues the way it's continuing, those will do fantastically well, and we'll be happy we did that. Your
reputation personally is this person who thinks 5 years, 10 years out. You're constantly thinking about innovation. But Andreessen Horowitz is a venture capital structure is relatively vanilla, right? There's carried interest and there's a management fee, and all of you are in the room and you're their investors and you're institutional investors. That's the basic venture capital model. Does that change?
So we made the decision. We knew that we were going to do some things differently. We knew we wanted to structure the firm differently, and you guys have seen that play out. We knew that we wanted to take a different approach to being stage agnostic. We knew we were going to want to experiment with different. We experimented with seed. We did growth things that were unusual. So we knew we were going to do a lot of unusual things. The two things we anchored on at the very beginning was the two things we weren't going to change was the economic proposition of the LPs would be the same, and the economic proposition to the founders would be the same. And we basically said, we think if we anchor on those 2 points, then both the founders and you guys will tolerate us doing a lot of experimentation along the way, because you fundamentally have the anchor points of familiarity. We're very happy we did that. I think we're very happy with the structure we have. Like everybody else in investment management, we have considered every alternative structure. You see more and more investors, both in venture capital and private equity, now asking the question of, isn't there some way to get to permanent capital? Doesn't Warren Buffett really have the right model, and can't we somehow get to Berkshire Hathaway?
Is there a venture capital version of Berkshire Hathaway coming at some point? Real venture capital, not a.
My understanding is the way the way the laws work on this right now is effectively no. And lots of people have looked at it and have concluded that it's prohibitive. Maybe if somebody were willing to run a giant reinsurance company with a venture capital operation on top, that would be very fun to watch. But I doubt it. I mean, the closest thing to that that's actually happening is, KKR and some of these firms going public.
Do you foresee Andreessen Horowitz ever going public?
No. I think Ben has assured me that he would retire and go to Bermuda. So that would be a showstopper for me.
So it'll be Andreessen Horowitz based in Bermuda. So that is a public company.
No.
No. Okay.
I think we're happy.
Andreessen Horowitz Reinsurance or whatever.
I think we're happy. Well, here's these guys all know this as well. Like we like the structure, and the other thing is like we enjoy our annual meetings. Like we have this sort of radical stance. We enjoy talking to our LPs, and so we.
That's because you started investing in 2009.
That helps. Hey, I got blamed for the 2000 crash. I'll take the credit for the 2009 rebound. No, I think there is an advantage. I mean, we learned this when we were running companies. I think there is. We talked about this with our companies all the time. There is a discipline that comes with taking your investors seriously, and it's a discipline that applies not just to the partnership with your investors. It also applies to the quality of company that you're building. Is that you actually take seriously the fact that you're deploying other people's capital, and so the fund structure, and having going back out and raising money. Like I feel like that's a healthy thing for us. I don't know. I'm not sure it would be a plus for us to get in a position where we wouldn't have to do that.
You talked about how the firm experiments a bit, and obviously the internal structure of Andreessen Horowitz has changed a lot since the early days when there was 2 GPs and you weren't going to take any board seats, and obviously there's been a lot of changes internally. One of the things you've kept consistent though is that a general partner has to have been a CEO at a tech company. Am I
somebody
wrong?
who's built a startup. I've never been a CEO.
Okay, fair. Or somebody who's built.
Somebody's built a tech company.
Given all the other things that you guys have changed from a model and a strategy perspective, why is that one stay consistent? Because
at the heart of how venture capital operates. There is a relationship between a general partner and a CEO, and often that CEO is a founder, and often that CEO is a founder who's the CEO for the first time. And there's a relationship at the core of that. And by the way, this is why we now go on the boards, is because we reconfirm the hard way that this is a necessary part of it. There is a relationship that has to do with the CEO of a startup developing into the CEO of a major company, which is what you're trying to do. The company has to develop, and then the CEO has to develop right along with that. And there are just very few people who are qualified to coach a founder and CEO into how to be a high-scale CEO. There are just very few people who are qualified to do that. And we just, if you talk to any founder who's had a board of directors and they've had somebody on the board who's done it before, and then they've had 4 people on the board who haven't done it before, they all say the same thing, which is the advice that I got that was actually helpful for how to be a great CEO was from somebody who had done it before.
Do you think that causes any problems internally when it comes to junior investment staff who don't have that experience, who know they cannot become a GP at Andreessen Horowitz, which is different than probably junior investment staff at almost any other firm? At least think there is a possibility that I could get that promotion at some point.
Yeah, so this is a really critical thing we decided to do up front, and this is a real trade-off, and this does, as you said, this does have consequences, but we were very clear with everybody who's come in, there is only one way to be a GP in our firm, which is to be hired in as a GP, to join a GP. There is no promotion path. We did that for a couple of reasons. One is because of the principle of who we think the GPs are, what the qualifications for GP are. But the other reason that we did that was because what you see in other firms is I would describe as Hunger Games scenario. A small number of GP positions, a large number of junior positions, and then a massive food fight, right, to figure out who gets into those top positions. And so we just observed over the years tons of politics inside. Now, by the way, it's a time-honored way of doing it, right? And a lot of partnerships got built that way, and a lot of investment banks got built that way. And there are firms, I would give certain firms, a huge amount of credit for running the Hunger Games scenario very well. President Snow did a great job at some of these firms, and there have been these protracted
with
knife
the beard,
fights.
By the way,
you think so? Yeah, little Donald Sutherland thing going. Okay. And so, it can be done. Like it can be done. We wanted to build a firm that had a culture of we're a team and we operate together as a team, and we don't have internal competition, and we're not the GPs aren't in a knife fight with each other. The junior people aren't in a knife fight with each other. There's no knife fight to try to get the promotion passed. There's no annual, compensation negotiation pool, bonus pool, like all that stuff. We just don't do that. Like we operate as a team. We operate as a team on behalf of our investors and on behalf of our companies. So that's what we don't do. There is the other side of it, what we do, which is we really respect professionals. And so we decided to structure, and this is how our firm is structured more like a company in many ways and less like a partnership, is we really respect operating professionals. We really respect experts in these areas. And we have been very fortunate, Ben and I have been very fortunate, and the rest of us have been very fortunate to have a team of operating professionals, both at senior levels and at junior levels, who are just superb. Now, everybody has been told that this is how the firm is structured, like it's a very clear deal up front. But I would say at least Ben and I are very, very happy with how that's
Could you ever see an exception to that?
Well, the problem is once you have an exception to that, then you
do. But I mean, okay, that's fine. But I'm curious. I mean, for a variety of reasons, to think there's somebody we want for whatever reason you want that person. Could you foresee that there is a type of person you want who didn't build a company, or from what you said earlier, couldn't be?
I think right now, I mean, never. I would say never say never on anything. Other than we like the way it's going. I would just say we think it's important. We think it's very important that when you're at the point of contact with the founder, it's very important that key coaching relationship have the right dynamic, and we think it has to be, somebody. They have to be paired with somebody who has built a company. Now, by the way, it goes back to operating as a team and operating, with professionals, which is we don't just have a general partner working with our companies. We have an entire team of professionals, right? So basically, what all of our founders experience is it's not you work with your GP, but you also work with an entire team of experts. And our companies draw on our operating groups in all kinds of interesting ways in order to do that. And what the founders will tell you is they basically feel like they're supported by an entire team, which again I think is the result of how we're structured, which would be very hard to do if we had the kind of internal food fight that you see at other firms.
You and I talked about this a little bit at a Fortune dinner last month, but I'm curious, given that and given the relatively small pool of successful female founders historically, does that mean that, and from what I hear from talking to headhunters, almost every VC firm in the Valley now is desperately trying to get a female general partner.
Correct.
Does that mean it's going to take you guys longer than almost anybody else?
Well, it is. I mean, it is taking us a long time. Yeah, no, it is because of this issue, because there's a relatively small number of female founders, relatively small number of female CEOs. There is a very limited pool of people who then are in this GP profile. I mean, we've been trying. Our first outside GP offer was to a very successful female founder CEO.
Can I take a guess? Will you say yes if I
don't? No, I won't. It's this. They're diamonds. I mean, it's just this extremely rare thing, and they have lots of options. It's a consequence of how narrow the funnel has been for women. The women you see this in corporate America. The women at the top of their game in corporate America are invited, have standing invitations to basically join the board of the entire Fortune 500, and as a consequence, it's almost impossible to get them in. So we view this very much as like it's something we very much want to do and plan to do and are continue to work very hard on. But you have to move the needle on this. You can't just say there need to be more opportunities for women at the top of the field. You have to open up opportunity at every level, and you have to attack this systematically. And one of the things our firm is like wildly disproportionately female in terms of its overall numbers. And I think number one, it's great for us because we get to work with all these incredible women.
And you've said that the performance of women is better than men. Yet you have no women in the general partnership. So
it's not. That's the thing. It's not a performance criteria.
Okay.
It's a definitional thing. But my point is, you have to expand opportunity. You have to expand opportunity and provide inclusion at every layer. And you have to build this up, and it has to be built up at every layer.
I'm curious, how do you guys analyze? One of the big differences between you and most firms in the Valley is this huge staff that you have. Some of whom are in the room, but this 90-person plus non-general partner staff. A lot of whom are investment professionals. A lot of whom are whether it be marketing or operations, et cetera. How do you get comfortable saying that we're producing the best returns by having this group, best returns for LPs, by having this organization rather than a much smaller organization, say, which is charging a much smaller management fee to fund them all?
Yeah, because we're voting with our own dollars on this one because it's money we're not paying ourselves in salaries, and then as LPs, we're LPs in our own funds, and so we're voting for it, with our own dollars as well, which is entirely geared towards being maximally competitive at the point of contact with the very best deals, and then doing the best possible job of helping to boost those companies to be as successful as possible, and that is something that I've been very clear with everybody on and will continue to be clear on, which is we're elephant hunting. Like, we're not going for a small game. We are not trying to, eke out gains in the margin where there's like, oh, this is a deal. If we invest in it, there's a good chance it'll get bought by Google for 3x in 2 years. Like, we don't invest in those companies.
Skype.
We pass on those all the time. Hey, Skype was a very, very good return.
I know, but that's what it was. Bought by not by Google.
No. We got a very good return on Skype. And so no, we got north of you guys know we did a good job on Skype. I'm very proud of that deal. We're going for the franchises. We're going for the big dominant companies. By the way, we didn't want to sell Skype. We would have loved it. We would love to still own Skype. So, in fact, we may yet get our chance. depending on what happens up north. We're going for the big game. The entire thing is organized around when we find out that there is a person or a team that really is going to really has figured out something important, and they're going to do something transformative. We want to be maximally competitive, and we think the firm is built to do that. To your point on scale, there's not infinite scale to this. Like, I don't know that it would make sense. Like, I don't know that the return from having 1,000 people doing what we're doing would make sense. But we have complete conviction that having 100 or 120 is a much better position from a competitive standpoint than having 60 would be or 40 would be. Like that to us is a slam dunk.
Let me talk to some industry stuff, and not venture industry stuff, but industry and stuff you guys invest in. One of the things you've personally been bullish on, not that they're all your deals, a lot of them are Chris's deals more than yours, but you've talked about a lot, is Bitcoin and blockchain, more broadly speaking. From your perspective, are we, the analog that gets talked about a lot is that it's like the internet in, say 96, 97, who thought that you wouldn't have to go to a record store anymore because you can make do email, similar concept. Has adoption of both Bitcoin explicitly, but also blockchain, has it been slower than you expected?
It's early. It was early when everybody was super excited a year ago. It's early now. It'll be early next year. This is one of those. I've written at length about this, but Bitcoin and blockchain is to money what TCP/IP was to data. It's an equivalent. It's an intellectual breakthrough. It's a computer science breakthrough. It's a systems breakthrough. Every computer scientist who looks at it comes away with the exact same conclusion, which is this is a big deal. This solves fundamental problems in computer science, and this is transformative to not just to financial services, but to the entire model of how trust works on networks. And how do you have a large-scale distributed network with lots of attackers, and then actually have people be able to do business in a way that's trusted, which is this really, really fundamental kind of thing. And then how are you able to do that in a way that's distributed at scales, the way that the internet has? And so we're quite confident that in the long run, this is going to be this is a structural breakthrough, and then we're confident there will both be very successful infrastructure investments as well as many very successful applications. As a venture capital firm, we're going to make many bets, right? And so we've made 2 big bets so far. We've made some smaller bets. We're in the market to make more bets. If it takes longer rather than shorter, we'll make more bets over time.
You think it will? I almost wonder if, and I don't want you to, I'm not asking you to slam your portfolio companies, but I remember probably 10 years ago hearing a venture capitalist talk about China when US VCs were finally starting to go into China and do deals in China. And he said, most of us are going to lose all of our money, but that's the price of being able to make money in 5 years or 10 years, being there and getting that understanding. Is that what blockchain and Bitcoin investing today is for you guys?
Well, most VCs lose all the money.
Right. But that was an intentional understanding that these are higher risk than even our regular investments.
No, I wouldn't. I don't consider these investments. I don't consider these investments to be higher risk. It's just the timing. The timing on the big breakthroughs is uncertain. The timing on the realization of the breakthroughs is uncertain. There's actually a formalization. There's a thing called Amara's law, and it basically is that the really, really big changes take longer to happen than you think, and then when they happen, they really are much bigger than you think. And so there are people were talking about for mobile. Let's just talk about mobile. Like, people were talking about the revolution of mobile computing basically from 1995 all the way to 2007. And in fact, I remember I went to a conference, a startup conference in 2006. Which was a mobile startup conference, and it was just, tales, litany of woe, right, of all the startups that had raised money over the preceding 10 years, and then tried to go to AT&T and get a carrier deal to get put on the deck, for the latest Motorola Razr, running Java, and it was just a disaster zone, right? And then the iPhone tipped, and then amazing things have happened. So the specific timing on these things, we do our best to call it, but we're going to do some things too early, we're going to do some things too late. What we are going to do is we're going to keep making the bets. This goes back to another thing that I think we're taking advantage of right now, which is I was about 5 years ago I started saying this and people were laughing, and I think it's literally turning out to be true, which is I would assert that virtually, maybe not entirely, but virtually all of the .com ideas from 1998 and 1999 were actually the correct ideas. Basically all the businesses that ridiculed then are actually working today. It was a timing question, and it was a market size question, and it was.
And you don't think the Bitcoin companies of today are the Pets.com of?
I think there's a good chance that this goes incredibly quickly. I think there's also a chance that this goes slower than expected. I think as VCs, I believe we're doing what we should, which is we'll make bets now, we'll make bets over time.
On blockchain, is there a tipping point? Is there an iPhone tipping point thing that you're kind of waiting for? And I don't mean an actual invention, but something that has to happen outside of you?
I don't have to. I think there are things that will happen. So I think there's 2 really big obvious things that are kind of hanging out there that entrepreneurs are now circling around. So one is global remittances. So global remittances are just a moral tragedy. global remittances, a huge amount of global migration of low-skilled, low-paid people. A huge amount of it is going to, going from horrible countries to slightly less horrible countries in order to get very low-paying jobs and a tremendous amount of abuse to be able to send money back to their families. And, for that privilege, the remittance companies take 10 or 15 or 20% of their income. And the whole thing is just horrible. And there's excellent opportunity with everybody with a smartphone, to be able to just come in with fundamentally superior service and really make a difference in quality of life. And these are very big businesses. And so that's a big one. And then another one that's gotten very interesting lately is machine-to-machine payments. The entire 50-year history of computer science, architecture of servers and networks and storage and all these things and software is all based on, there's no concept of economics in computing architecture. And so that's when you get these, you see this as a consumer, you're on your cable modem, and your neighbor is, downloading, House of Cards or something. And like you can't, your kid can't do their homework. So you get this contention, and there's like literally no way to pay, to be able to get priority. And we live in a world in which Internet of Things, right, there's going to be a chip embedded in everything, and everything's going to be on the network, and so you're going to have devices that are going to want to be able to pay other devices for the ability to get things done. And up until Bitcoin, there is no way to do that, and Bitcoin is the way that can be done, and so very smart systems architect kinds of people now are working on this. And so those are two obvious ones, and then there's another probably half dozen right after that.
Let me ask you another question, different part of industry, but if you look at that unicorn list, there's probably a decent cadre, including Uber, obviously, and Lyft, which is in there, which is on-demand economy, but specifically on-demand workers. And we've obviously got two big court cases in California, one with Lyft, one with Uber, but they're effectively the same case with two different companies. Are you concerned that this entire industry is predicated on a legal construct that the courts might strike down, namely that these folks can be essentially contractors?
I'm not. I would probably defer to Ted Elliott's here, who runs our new regulatory group coming out of Facebook. I would probably defer to him on the specific answer to the question. I think it's growing, I guess I'd put it this way, I think it's growing increasingly unlikely that would be the case because these are becoming huge businesses.
But even if, in other words, could you foresee that industry, and I know it's broad, include Instacart, all that in there, surviving if these people all had to be W-2 employees?
I think there are models where that would work just fine. There are models where that wouldn't, but in the models where that wouldn't work just fine, the outcry that you would get from that change at this point would be profound. I mean, it's these things. Some of these things have become movements, and I would put ride sharing in that category, and I would put Airbnb in that category, right? And Airbnb is doing extremely well, but still faces huge pressure in New York City in particular. Like, it's a movement, and there are homeowners who are in their houses because they're able to continue to rent out an Airbnb, right? And there are guests who are coming to New York City and are able to stay, and do all kinds of interesting things because of Airbnb. And so one of the questions that you have at Airbnb is like, how many thousands of people do you want to put on the governor's, mansion, front steps at any given point in time? Like that, these things. There's a lot of people now who are extremely enthusiastic. A lot of drivers for Lyft and Uber are extremely excited that this opportunity exists for them, and in fact, very excited that they can do it whenever they want and that they don't have to sign up for a full-time job. And so I have a hard time seeing. I think there's a popular will component to this. I have a hard time seeing the genie gets put back in the bottle on some of this stuff. And then, look, the other thing is I believe we have ethics and morality on our side on this one, which is I think that these are new options for people to be able to make money, and I think new options for people to be able to make money are a good thing.
Well, speaking of Lyft, I'm curious, if you had a pie chart, and you probably did maybe at some point, of all the reasons to invest in originally, how big was the slice of stick it to Uber?
Zero.
Zero?
Zero.
Completely
yeah.
zero?
We don't make investment decisions like that. I hate to disappoint you.
Let me rephrase. Maybe you don't put it in a pie chart because that seems petty. How much in your mind?
None. Zero. None.
Okay.
Zero.
And speaking of...
By the way, Lyft is growing extremely quickly.
And it has a new investor. So how is it being co-invested with Carl Icahn?
We're going to have a nice, collaborative, non-communicative relationship.
Can I ask? You talk about all the things that should scare entrepreneurs about going public, and one of them is somebody like Carl. Did you mention to Logan you're bringing him in now?
We had a fulsome discussion. He's a very, very small minority investor with very tightly contained. So I'm not, in this case, I'm not worried about it.
Okay, that's fair. There was something. One of the things in that New York article is I think it was Ben saying it, but somebody talking about you particularly, about how I think. Talking about how he said sometimes you go all Wisconsin, I think is the way he phrased it, or something like that, and talk about how what you guys are investing in or what you should be investing in are things that ultimately are for everybody, not things that are just for folks in Atherton. How much, I'm curious, as a piece of that or as a side of that, how much is do no harm a piece of your philosophy or not a part of it?
I mean, I think it's an important underlying. I mean, so I'll just give you an example. The one thing we have in our firm. So generally speaking, what we have in our firm is a model. We don't vote on investments, right? So we don't have a consensus-based model. We don't get to 100%. In fact, we don't vote. And in fact, each GP has specific budgets, and they can basically pull the trigger on the investments that they want to do. There's basically only two overrides we have in the firm. One is, we have a basic structural, override, which is, there's certain ways that we do investments, and so we oversee that. But the other is we have an ethical veto, and so any senior member of the team can ethically veto an investment, and there have been investments that have been ethically vetoed, and in fact there have been ethical vetoes that I have disagreed with, but there is an ethical veto. So I think from a practical standpoint, that is something that we do have both as a value of the firm and as that we've actually implemented the investment process and it's less a statement of here's necessarily what we believe. It's more a statement of we should be making the investments that everybody around the table feels ethically comfortable with, which I think has that effect. As you're aware, I am a huge proponent and a believer of the idea that technological progress is in, I don't know if every case, but in an overwhelmingly large percentage of cases is ethical and moral progress. And I'm delighted to talk about that at length. And so I from a moral standpoint, I feel really good about what we're doing.
I'm curious, can you say, without identifying a company, give an example of where there's been an ethical override? What type of company? Yeah.
High interest lending to consumers with high credit risk. So various derivations of, various kinds of pawn, kinds of things, various kinds of just high interest.
That's interesting you say pawn, because I go back to that New Yorker piece, which seemed to be you arguing for a pawn.
Yeah. I wouldn't.
So that wasn't you.
No, it wasn't me. I argued against it. In fact, the term limousine liberal might have been thrown around a little bit in that discussion. I mean, we ultimately had ethical. I totally respect the views of my partners who disagreed with me on this, and we didn't make
the limousine liberal.
We haven't made the investments, but that is an example where. There is an argument to be made, and it is look, there is an excellent argument that the companies that end up being in the business of high interest lending, to high interest rate consumers end up, over time there's been this pattern of these kind of very opaque business practices, and there's kind of this thing of are you incented to kind of get people locked in this pattern of sort of high interest rate payments. My counter argument on the other side is that people with high credit risk need credit too. And in fact, they arguably need credit more than anybody else because they're the people at most risk of if they're if they get fired from their job or if they get a late paycheck or something, they're at serious risk of not being able to feed their kids. And I think that I think there are very, very strong ethical cases for that kind of thing, but it was the kind of thing where we weren't comfortable enough with it as a group, and that's fine.
Final question for you, which goes kind of to this, which is you're not from here, but you've been here for a very long time. When you're analyzing companies, new opportunities, how cognizant are you of when you hear, particularly if it's a consumer sort of business, not an enterprise business, are you of well, yeah, that might work here because of what here is. This issue of does it expand? Can it get to everywhere else? And outside of San Francisco and New York, do you feel you can get out of that bubble? Do you feel your partners can? Because this is where you live. These services are kind of part of here.
Yeah. So I've actually come to believe the exact opposite. I've come to believe that the entire way that these things work is I've come to believe that the entire basis of that theory is actually 180 degrees wrong. That really what happens is these things start with early adopters and then they mainstream. And that happens actually, I believe, not because the technology is mainstream. I think it's because the rest of the world becomes more like the early adopters. I think people are becoming more like the nerds. And in fact, we have a very specific theory on this that Chris has talked a lot about, which we call Nerd Nation, which is literally this idea that in the modern world, the global market of early adopters for new technology products now is a large market by itself. So the number of early adopters for the next new, whether it's the Apple Watch or the iPhone or whatever it is the new thing is, that's 50 million people worldwide, right? And 50 million people worldwide is a large market. 50 million people is the total market size of the entire internet in 1999, right? Which is, by the way, was the same set of people. 50 million people is a lot of people. And so if we can go build a business that's 100 million going to 500 million, going to $1 billion in revenue on the first 50 million people who are all the nerds and early adopters, that's great. And then what happens is everybody else over time, we live in a world now where everybody's going to be on the internet, which was very much a nerd activity not that long ago. I think people adapt, and so I've come around to the other side, which is it's an incredibly strong positive indicator when you have a high level of nerd adoption, and we tilt right into that. I'll also come back to your we don't fund things for rich people. We do believe in cynically exploiting the rich to bootstrap the cost curve to be able to build products for everybody, and so I'm very inspired by Elon Musk. And Elon Musk in 2006 laid out in a blog post, and he said our plan. He didn't use the word cynically exploit, but I added those for effect. He said, our plan is very simple. We're going to build a very expensive sports car for rich people, and then we're going to build a mid-sized sedan for kind of professionals, and then we're going to build a cheap car for everyone, and then, by the way, we're going to solve energy for the world, right? It's like a 4-step plan, and it literally for the last 10 years is exactly what Elon has been doing. With the new battery thing, and he'll be out with the $30,000 car in the not too distant future. And Elon got, remember this, Elon got tons of flack in the beginning for how can you feel good about yourself building a fancy sports car for Leo DiCaprio. And the answer was it's a subsidization model. The rich people will subsidize the products. And
plus, he wasn't even delivering it really to Leo DiCaprio. Well, he was just taking the money.
The pre-order was helpful. And so I would say you should consider, you guys should consider that we will do a lot more of this. We love models that do that. We love models that go after the nerds first, and we love models that go after the rich people first. But the goal is always the same. The goal is to come down the price curves, to broaden out the market, and have these be products that everybody gets access to.
2 final quick questions for you. And it's tricky. You said you view yourselves more as a company, perhaps, than as a traditional venture capital firm. Mm-hmm. And Scott referred in his thing to customers, and he referred to the folks in this room as customers. Are LPs your customers? Or are the portfolio companies your customers?
Both.
Okay.
Now, different relationships. I mean, at the core of what we do is we're a fiduciary, and we have a responsibility to our investors. But the way that we exercise our responsibility to our investors is to pick the best possible companies we can find, and then to work with them as much as we can to help them be as successful as possible.
And final thing, I sort of asked you this at our last meeting too, but I asked some folks over breakfast what I should ask you. So 3 people said the exact same thing, so I will ask you, which is, now that it's been a few months, how has being a father changed you professionally, do you think? Or you as a person?
Oh, I don't know. I'd have to defer to my partners on that.
Do you think it's changed?
It's all so new. I have no idea. I don't know. It's also new. He's only 3 months old. That's a pretty big burden to put on him. I don't know.
I wasn't blaming him. Blaming 3 months.
He's amazing. We're just getting started. We'll see where it goes. Okay.
Thanks, Mark.
Good. Thank you. Thanks, everybody.